I'm Drew Waterbury. As a financial planner, I try to help my clients plan not only for the financial aspects of retirement, but also for the experiences that come with aging that we would probably label as non-financial. I interview people who are service providers and thought leaders in the area that we would consider these non-financial challenges, what I consider to be the other side of retirement. This conversation, though, is going to shift back to the financial considerations of retirement. I'm often asked about reverse mortgages and what my thoughts are about using one. Today's guest is my response to that question because I think the best way to explain this, what is a reverse mortgage, is to speak to a specialist in this area. Joining me is Christian Mills. Christian, can you get us started by sharing a little of your background and what led you to your current role as a reverse mortgage specialist?
Sure. Thank you, Drew. I've worked in retirement income in some way, shape, or form, predominantly in the 401k space for, 25 years now, Drew. And prior to joining RMF, I'm fairly passionate about people, saving money and how do they have their best retirement. These are everyday people. So teachers, nurses, firefighters, police, the middle America, the mass affluent, if you will. And prior to RMF and prior to working for the national FPA, I used to think reverse mortgages were something very different, and I didn't think of them in a kind way at all, Drew. I don't know where I got that idea. I drew that from the ether. Working at the Financial Planning Association, I was exposed to the Journal of Financial Planning and several articles that started to be written in 2012, and I had a 180-degree mindset change. For most Americans, until we get to the really the top tier of 5% or more of the wealthiest Americans, the home represents half, if not 2/3 of the average American's net worth. So how can we use that to have a better and more secure retirement, and whether that means being able to travel more or simply being able to, enjoy going out to dinner with friends or not worry about healthcare costs. So I became very interested in it and actually joined reverse mortgage funding based on their interactions working with financial advisors, because that was a space that I knew. So I was kind of led here, I think, Drew, just due to the passion that I have for working in retirement. And this is a new program from what a lot of people would think it is. A lot of new protections, changes that have made this a more viable financial planning product. So, with that, that's kind of how I ended here. I'm actually, became a loan originator myself, at my license, et cetera. And then now I'm the head of financial planning, the head of financial planning channel at Reverse Mortgage Funding, which leads me here talking to you today.
I probably had a similar experience or perception of reverse mortgages as you did. And I think there were, when I read about the criticisms of reverse mortgage, it seems like a lot of those problems were things that existed prior to, I would say, 2008. And I've seen some of those problems firsthand, where an advisor would encourage somebody to take out and I'm using one example. An advisor would encourage somebody to take out a reverse mortgage and then invest the money. Conflict of interest there, or to buy an annuity or something along that line. And that was my experience. And then was it Wade Fowler? Who was the first one, or who was the first one who started writing about this? Because I know I've read about this too in financial planning journals.
So in 2012, there were three really kind of key articles, and the first was written, it was conjunction, but two of the main authors were Barry Sachs and Harold Levinsky. In 2012, and that was the idea of using the line of credit that comes with the adjustable rate reverse, and establishing a line of credit that they could draw from in times that they needed. And specifically, one of the cases they used were having a long-term care, self-funding long-term care by using a reverse mortgage. So Sachs, Levinsky, John Salter writes about this as well. A number of people, but Wade Pfau is, probably one of the top scholars that we see today. And he's on his third edition that came out in March of 2022 this year, writing about how reverses can be used. It is a math book. He is a PhD and a CFA, and writes and gives you several different examples of when a reverse could work, or ideas of when those would work as well.
Mhm.
So, those are
Before-
lots of academics,
Yeah.
have been writing about this for a while now. Yes.
Okay, before we get into the applications of how you could potentially use a reverse mortgage, let's revisit the history. Can you give us kind of an abridged version of
Absolutely.
history?
So, first of all, reverses are used all over the world. Folks in westernized countries, Australia, Canada, the United Kingdom, reverse mortgages are very common. So we're not alone there. They started in the United States in the 1960s in the Midwest with banks underwriting what would become a reverse mortgage. 1989 actually was signed into law under President Reagan. And at that time, Drew, it really was, it was geared for the classic house rich, cash poor person who maybe was just getting by on Social Security, a very small pension. We saw the decline of pensions and then the rise of 401ks after ERISA in the mid 70s, 1974. So, that it started out being a loan of last resort, or it was for people who had nothing else saved. Fast forward into the 2000s, we started to add protections into place. And then, when 2008 happened, the mortgage industry overall was overhauled with things like appraisals, financial assessment. Can you afford this mortgage? And it was a good thing in my estimation. Then we looked at adding other protections for non-borrowing spouses. The money is yours. If you take a reverse out, you can do with it what you want, but you are strongly encouraged to use this prudently and to live on, essentially. So, what we don't want you to do is take out a reverse and invest in crypto, let's say, highly speculative, and you could lose everything. This is meant to be, to pay your bills, to have a better retirement, to have a safety net in case there's a healthcare crisis or something along those lines. And then we get to 2017, the program was overhauled. So we lowered the amount that people could borrow against the home, which, what that did was it made the program more sustainable and longer lasting. So you couldn't take out, almost all the money in the house and use it, and therefore eat up all the equity. With today's reverse mortgage, unless there are unforeseen circumstances, there will be equity remaining left over when the person leaves the home or sells it. So if they're going to leave the home to move to a place closer to their family, grandchildren, adult children, or whether they're going to buy their way into an assisted living facility, there's typically funds left over after they sell the home and pay off their reverse. So it's a much different program. And with 2017, we started to see higher amounts that people could borrow against because homes are worth a lot of money these days. So as of 2022, the amount we can consider on a home is $970,800. So just shy of $1 million. That to me, says a lot. This is not a loan of last resort. If we're looking at $1 million homes, we are using all the assets that a person has. And when I work with financial planners, I try to work with planners. I mean, that word is important. And whether they have a certain designation or not is not as important as, are they looking holistically at all of their clients' assets? If they're looking at everything, what do we want to do? Do we want to leave a legacy for our children? Do we want to have a philanthropic legacy for ourselves, or whatever that might be? These are the things that are going to help people have a more successful retirement.
For the people who might be watching this video who are not planners, though, they're trying to learn the mechanics of a reverse mortgage. How would you describe it to the man or the woman on the street? As far as, we all know what a mortgage is. Everybody knows what a mortgage is. You wouldn't be considering a reverse mortgage if you had never entered into a mortgage for the first place. So just talk about the nuances of a reverse mortgage.
Sure. So the reverse is, first of all, typically if you're using the HUD sponsored product, which is it's shortened a lot of time to HECM, which stands for Home Equity Conversion Mortgage. A lot of people call it the HECM. And the HECM, you need to, one of the spouses needs to be at least 62 years old. You need to live in the home as your primary residence. You need to maintain the home and pay property taxes and carry homeowners insurance with that. And with that, we're able to, depending on the age of the youngest borrower, the value of the home and the margin that's chosen, we're able to either pay off a forward mortgage, establish a line of credit, or a combination thereof. So establish a lien against the property, and with that, we're able to lend this money. It's considered a loan, so it's not taxable, which is very important to notice as well. So it can be used for a lot of different things. It makes it a very flexible tool when it comes to the financial plan.
So my understanding is that it can be used only on your primary residence, not on a second home, a vacation home.
That's
of course,
correct.
you could tap the equity and use those payments to pay for that vacation home.
So, and that's actually a play that we see where people will use the reverse mortgage to buy a home that will become their retirement home. So while they're still working, let's say in their 60s, they'll take money out of their primary residence, use that to fund a second residence that they're going to retire at. That could be at the beach or the mountains. It could be closer to family. And with that, they're able to transition and make that transition smoother when they actually do retire. But the home that we take this out on is their primary residence. And that is the definition of the IRS, which is 6 months plus 1 day. So, and here's the other thing, Drew, is you self-select that. Nobody's looking over your shoulder. Nobody's coming in, knocking on the door. You affirm positively that this is your primary residence. We really don't have many problems when it comes to that, Drew, about what about the residence itself. So, working with planners, we do have clients that have multiple residences, and it's just the one that they affirm that is their main residence. Yeah.
Okay. But of course, we don't offer tax.
No, we're not offering tax
Guidance here.
advice. Exactly.
This is just general information.
Yes.
And I'm sure if I have a house in Florida and a house up here in North Carolina, if I claim residency in Florida, North Carolina wants to confirm somehow so they know whether they should be getting my income taxes.
That's right. And
there are other aspects here to take into consideration.
You do bring up an important point, though, and I usually try to repeat this at least twice when I'm speaking with people. The funds you take out in a reverse mortgage are tax-free. You bought the house with after-tax dollars. The money that you take out of it is not taxed. So it is a tax-preferred status. Again, I'm not a tax expert. We're not offering tax advice, like you said. We're encouraged to say the same thing by complying with legal.
Right.
But it does have a tax advantage status, so you can use it for things like purchasing another home. Something we're seeing now with the rates in 2022, using this as something to fund a Roth conversion, because we have tax advantaged funds. We're going to pay taxes on future money, and that's a legacy planning value that becomes a little bit more not esoteric, but it certainly is a higher use or a more advanced use of the reverse, which people would typically use if they have a plan.
You may have touched on this already. I'm sorry. I have some notes that are floating around my desk. I'm trying to make sure, because this is a great topic. It's really a source of a lot of confusion for people.
It is.
There's kind of like buyers. I don't know if buyers. I won't say buyer's remorse. There's hesitancy, because if you don't make changes, you don't think you're making mistakes. Whereas if you do make a change, such as getting a mortgage or a reverse mortgage in this case, there's always did I do the right thing? Did I do the right thing? Did you? That's why I have all these notes that I probably should consolidate instead of having Post-it notes and things written on the back of pages here. But did you mention the age restrictions?
Sure. So
I'm not sure if you already did. I don't want to interrupt you here, but if you already did, we don't need to cover that.
Absolutely. It's 62 and above for the home equity conversion mortgage, which does all the heavy lifting in the reverse world. That's still about 90% of the reverse mortgages out there are the home equity conversion. With that, one of the spouses, if it's a married couple, need to be 62 years old. If you have proprietary options, at least with reverse mortgage funding, we have options that start at 55, and that's governed by state law. So mortgages have an overarching federal umbrella, but the state by state, there are different rules that are in place there.
So if for no other reason than the proximity of age when most people are retiring, this is probably something people should be thinking about as they enter their 60s. Does it make sense? maybe not wait until they're 70 to make that decision, but at least
More,
start considering it in advance.
sure, more and more, and if you read Wade Fowle's book, he actually draws a bright line. There are lots of different qualifiers here, but he uses a figure of $870,000. Before 870, if you have less than $870,000 in liquid assets in your IRA, let's say, he encourages you to consider taking out a reverse mortgage as early as possible. So at 62, using the 10-year payment, so you're getting a monthly tax-free payment, and with that, that is going to help. I can't say the word guarantee, but make sure that you're not going to run out of assets before you pass away. Above 870,000, he likes to look at the line of credit and using this, either as a long-term care play, potentially, having this to use later in life when we're going to have higher healthcare expenses statistically. But it's a very flexible tool, Drew. So two of the things that we see a lot, especially during the pandemic, people that wanted to retire. We all heard about the Great Resignation. Well, if I retire at 62, I'm 3 years away from Medicare.
Right.
I know that if I wait until age 70, I'm going to get a much higher draw on my Social Security. So people will use it as a bridge to bridge into being able to assume, being able to take their best payment on Social Security. And that's, we don't offer Social Security advice. That's where we refer to the planner, to people like you, because, there's a lot of factors that go into how you claim Social Security. But certainly in today's world, carrying health insurance, that's a need for a lot of Americans, myself included. So I want to be able to have high quality healthcare and access to that when I need it, because an unexpected, you're in the business, an unexpected, health expense can wreak havoc with a financial plan.
Sure, absolutely. And one of the things that, and you mentioned this a little while ago, but one of the areas that I think it's reverse mortgage can serve as a valuable resource is when we have market pullbacks. Like,
yes,
you and I talked back in March, and even then it felt like, wow, might be a tough year. Well, now it's early June or mid-June, and we've seen even worse erosion of equity values. So for somebody who's trying to draw money, they've entered the retirement years, so they've stopped working. They're no longer adding to their retirement resources. They're starting to draw from them. Well, you start drawing from a market that's dropping, and these are assets that you're not giving an opportunity to recover. We know that the markets are cyclical. Sometimes that cycle lasts a little bit longer than we would prefer it to. But the truth is, once we spend that money, and you've heard me use the expression money heaven before, once we've spent that money, we've liquidated mutual funds to support our lifestyle at age 65, 60, whatever the magic is. Those are units that cannot appreciate in value, that cannot recover when the market hopefully resumes its upward trajectory.
Yeah,
shouldn't have trouble with that word, trajectory. But that's where I see a very important use of a reverse mortgage, because you can tap into those resources. When the market recovers, you can liquidate at higher prices to repay what you owe on the reverse mortgage.
Yes, absolutely. And thank you for pointing that out, Drew. A lot of people think of the reverse mortgage as a no payment system, and it's actually an optional payment system. So putting money back into the reverse is it can be a very, it's a valuable tool, because every dollar you put into the HECM, every dollar for dollar, if you're paying back, either the loan itself or interest or the mortgage insurance, dollar for dollar, a dollar you pay into a reverse goes into the line of credit. And that line of credit, at least in the HECM, the line of credit and loan balance grow at the same rate by law. So right now we're somewhere, let's call it about 4.5%. And if we have that margin in the index, which is the CMT, everybody uses exactly the same index, and everybody uses exactly the same formulas on the HECM. There is no deviation between what a firm like RMF can offer from, say, one of our competitors.
So let me interrupt you for a second.
Sure.
So they're really, unlike maybe a traditional mortgage, there's really no advantage to shopping around.
Well, I would say, getting it where you're going to see the differences are going to be, origination fees or any fees that might be advanced. In my estimation, in RMF, we're a direct lender, and there are several direct lenders out there. That means we don't have middlemen. We're not, brokers can use the RMF product. But when you work directly with a direct lender, you're going to get the best pricing because we're removing somebody else that has to get paid, just to be candid.
Yeah. Okay.
So shopping around, some of the strong points that RMF offers is we don't sell our loans. So the loan originator that you work with in the beginning is the loan originator that stays with you for the life of the loan. That's not such a big deal in the forward mortgage world, Drew, but when people get into especially when they get into, like, say, their 80s and 90s, having that familiarity, and you've got their business card or it's in your phone or wherever you keep their contact info, those are the people who call. And there's a sense of safety and comfort with that. And a quick example, I live in Colorado. We had a very big wildfire that touched north of Boulder, Colorado. And I had clients, thankfully they were not affected, but they picked up the phone and called me. If my home is destroyed, what happens? And I'm able to tell them that's why we have mortgage insurance. If your home is destroyed, heaven forbid, you're able to rebuild that. But we're operating under the assumption that it is the same value that it was before. So you are able to do that. And circling back around to what you were referring to earlier was, I believe, sequence of return risk, which is having to sell assets in an inopportune time. And the classic would be, I bought stock ABC at $100 a share, and now it's trading at $30 a share. I still need money to live on. I don't want to liquidate stock ABC at $30 a share because I lock in a loss of $70. That's an extreme example. We haven't had to think about that for almost 13 years. We're at the end of a bull market of historic magnitude, and who knows what the next few years will bring. But bright minds are saying that it's going to be choppy waters for a little while. We've had smooth sailings in the market for quite some time, and in fact, I work with planners now who've never seen a bear market. They've never seen an upside down. What we do effectively, the simplest way that I can explain this is, you'll hear a lot of people talk about the three-legged stool of retirement. So the three-legged stool is Social Security, employer-sponsored plan, and personal savings. When we employ reverse mortgage, we add a fourth leg to that stool. And as the son of an engineer, I'll tell you, 4 legs are more stable than 3. And we're drawing from those assets. It gives us a separate bucket. And very important to note with the reverse, it is an asset that in most parts of the country, the home is worth more than it ever has been worth. Mm-hmm. We have home ownership rates of almost 80%. I want to say it's like 78.6% of Americans 65 and above own their home. So we have a very high asset. We have people that own homes because when we're older, we are able to buy homes when they're less expensive. And most importantly, it's an asset that's not correlated to the market. Home prices are still rising right now. The market can be in flux. It's one of the best times that you could use to buy or to employ a reverse mortgage. So you're adding a non-correlated asset, it's a buffer asset, to put it bluntly.
Okay, so there are people who think that we might even be in a housing bubble there with these elevated prices because it's gone up so much over the last few years, and there are reasons for that we don't
guess that all day long, I'm sure.
Yeah, right. I know. Yeah. If I took out a reverse mortgage today and we go into a housing slump where all of a sudden market values depreciate, what are the implications for me?
It's almost like you asked this question for me, but thank you. The way the reverse,
we should have shared a script. We're gonna save this both some time.
No, I like it better fresh like this. So the way the reverse works is, first of all, you have to get counseling. So there are a number of checks and balances that have been added through the decades that this has been in place. And one of those is we get an independent appraisal. First of all, they have to get counseling with an independent company. The loan officer can't be involved in that, and it's to make sure the homeowner, the financial advisor, if they want to be on that, they understand what this is. Here's the rules. Here's what your responsibilities are. But when the second part of that's another check and balance is we use a double blind system. So we use an appraisal management company that randomly chooses an appraiser. The appraiser then, we estimate the home is worth, let's say, $485,000. they come in and they do their magic and they say, this home is worth $500,000. It is a snapshot in time, Drew. So with that, we're going to say the home is worth $500,000. Now, if the market does crash, because we're using this as a snapshot in time, the home is still worth $500,000. When we're looking at it, it does, the appraisal is set in time. It doesn't fluctuate. So you actually have a protection there. And it works conversely on the other side. Let's say the home is worth $500,000 and that, in 3 years, it's worth $700,000 because we're in this crazy housing. Yep. You can refinance the reverse. So, with interest rates the way they were the last 18 months, 2 years, and home prices increasing dramatically, we're coming off a period of huge refinancing. So a lot of people refinance their forward mortgages in this environment because it was an opportune time to do that. But also you have people who are refinancing the reverse because they want to capture lower interest rates and a higher home value. So they're accessing more equity because the home is increased. So you can refinance a reverse just like you can a forward. In fact, when you refinance, the calculations are more stringent than they were. There has to be an economic value for that homeowner to refinance. Okay. So it's not just HUD looking at that, it's the state and the company as well.
So I don't need to worry about my house depreciating in value once I've taken out that reverse mortgage. I'm fixed.
Yeah.
Okay.
You're correct.
Let's talk about closing costs for a second. You mentioned closing costs. Sure. How do the closing costs compare to a traditional mortgage?
So with the HECM, and that's one of the things that happened in 2017, which gave a lot of people pause. You pay 2% of the appraised home value that goes into a mortgage insurance pool. Now, on a $500,000 house, that's $10,000. So on a $500,000 house now, the closing costs are probably going to be somewhere around the $20,000 mark, which is expensive, comparatively to a forward mortgage. But if you look at the cost of that compared to buying like an annuity or something along those lines, it's low. And nobody brings that money to the table. I've had one person, and it was the parents of a financial planner who actually paid their closing costs at closing. Almost everybody says, okay, I'm gonna roll this into the loan. It's going to give me access to it. You can pay those down if you want to. So it does have a higher price, but it's very important because the mortgage insurance protects you in a number of ways. The most important is all reverse mortgages, whether they are HECM or proprietary, are non-recourse loans. And this is important. Non-recourse means you can never owe more than the home's worth. So if you were to get into a situation where your loan balance was higher than the value of the home, which it's much harder to do since 2017 because they lowered the amount you can take. Most people are going to see remaining equity when they go to sell the home. Because at least, right now, home values are appreciating faster than the interest rate on the loan itself. But if you did find yourself upside down, Drew, and let's say the home is worth $700,000, but you have an $800,000 balance, that when you leave that home, and you can live in there as long as you want to. In fact, if that was the situation, I would encourage you to stay as long as you can. But when you leave that home, basically it becomes, you hand the keys over, it becomes a deed in lieu. It's the only time that the bank takes possession of the house. And with that, it is you walk away. There is nothing else. It's not attached to IRAs. It certainly doesn't affect your heirs or anything like that. In fact, if it does get upside down, your heirs can buy the home. They're first in line at 95% of the appraised value. So if the home itself had significant value, from a family standpoint or something that was important to hang on to, the heirs always have the chance to buy the house first. But
so they're always, mom and dad go to a retirement facility, they leave the house, they're no longer primary residents. So yes. They can no longer continue the reverse mortgage. The family members, children, I'll just throw out children, sure. They always have first right of refusal regardless of the circumstances.
Unless it was written into the will or the trust in some other way. Yes, they can. And typically what happens there, if they want to buy the home or they want to keep the home in the family, they can refinance it with a forward mortgage, because at that point, although people are living longer, you actually do have a possibility of children being able to use a reverse for that too, if their parents were, let's say, their late 80s or 90s. but they have the chance to refinance it and decide. This bears repeating, I think, Drew, because simple math is if you have a $500,000 home and a $200,000 reverse mortgage loan balance, just like if you had a $200,000 forward mortgage, when you leave the home, when they sell it without realtor fees, et cetera, they're going to pay off that lien against the property, whether that is a forward, a reverse, or a HELOC, and then the remaining funds go to the heirs. So without trying to figure out realtor fees, et cetera, if you sell a $500,000 home, there's a $200,000 lien against it. That 200 gets paid to whoever holds that note.
Mhm.
The remaining 300 go to the owners or the heirs, whatever the case may be.
Yeah, I think it's interesting to note that at least the people with whom I've talked, the adult children, mom and dad are hanging on to the home, and the adult children have created their own lives. They
Yes.
don't have much use for the physical home itself.
Sure.
They've got their own life that they've created. And I
Yeah.
think sometimes the older parents are reluctant to undergo maybe a reverse mortgage because they think that they're preserving something for the kids.
Yes.
When the kids would rather see, I say kids, we're really talking about adult children, right?
Mhm.
They would rather see the parents more comfortable and have more, financial freedom
Sure.
that a reverse mortgage can maybe attain for them. Let's talk about interest rates. How do the interest rates compare versus a traditional mortgage?
So they're typically about 50 basis points or half of 1% higher. They can be higher. With the reverse, though, you also choose your interest rate. And to some degree, depending on the situation, Drew, a higher interest rate works in your favor. Now, I'll give you a quick example here. And this is why you should talk to a reverse mortgage specialist, because, at least with RMF, we have 90 different combinations, 90 plus between rates, products, depending fixed, adjustable, whatever that might be. But if you're going to use the reverse mortgage to bridge the gap towards Social Security, let's say, or you're going to use the reverse for a long-term care play, those have two different strategies and two different tactics that you would employ to achieve that. With going to Social Security, you're going to choose the lowest interest rate, and we call that max funds. You're going to get as much money as you can, and it keeps the lower interest rate. So if you want to pay it back, it's preserving equity. But if you're using it for a long-term care play, and the home is paid off, you want to get the highest line of credit that you can, and a higher interest rate is going to make that line of credit grow. We're not allowed to use the term interest because this is money that you're going to borrow against the house. But I would want, if I can get an extra 1% for money that's growing at a tax-free status, that's what I want to do. I want to have that line of credit growing. So in that instance, I may very well want to choose a higher margin, which would relate to a higher interest rate. So, in interest rates, we hear about them, and there's, gas is rising, inflation is up, and all those sort of things. We can't control that, Drew. I think of interest rates as the weather. It is what it is. You can't control that, but I certainly can bring an umbrella if it's raining outside. So I want to take that and consider, all my options when that is. What doesn't change is when people need or want to tap home equity, that's what they do. They've got it there. The interest rate is what it is. And if the case may be you want to refinance it when things are better or have a lower rate or whatever, you can do that. But to some degree, the interest rate, is static. It shouldn't prohibit you from thinking about a reverse, because it can actually benefit you. So.
All right, why get a reverse mortgage versus a home equity line of credit?
Okay, great one. And a HELOC, a home equity line of credit, it has a place. If it's something you can do very quickly. You can go to your local bank that you dealt with and lower closing costs, et cetera. The difference is it can be called, canceled, or reduced at any time. Going back to 2008. There were a lot of people, small business people, will use a HELOC to carry themselves over if their income fluctuates. So let's say you're a realtor, or you're in sales of some kind, or whatever that looks like. People will take out that HELOC and say, this is the money I'm going to live on when times get lean. In 2008, we saw those be canceled. You can't take any more money out, start to be recalled. Hey, you need to start making payments. The HELOC is at the bank's discretion. And when times get tough, they can recall that because they don't want to be on the hook for money that might not get repaid. With the reverse mortgage, it can never be called, reduced, or canceled. It's protected by law, so it continues. It has a lot more protections than you have in place, with the HELOC.
Yeah, it sounds like
Yeah.
it sounds like the HELOC can get called in during stressful economic times, which is when you probably will need to tap into the resources of the reverse mortgage to begin with,
And if
or the HELOC.
Yes, if you remember in the beginning of the pandemic, so this would be kind of April, May of 2020, there were people that said, hey, you can't take any more money out. They stopped offering HELOCs. I know some big banks, and one of them was mine, I won't say the name, they raised the effective rate to about 10%, which didn't say you can't take any money, but it made it so, unpalatable that people are not going to, hey, I'm not going to take it at 10%. That's like a hard money loan or something like that. So people did that. It didn't last very long, about 4 to 6 weeks, because it didn't, come to pass. But there was a hiccup in the market, if you remember, at the beginning of the pandemic, and people with HELOCs that were relying on those, they certainly had a scare for a month or two.
Yeah, we can't loan you the money, but we can refer you to a loan shark we know that can get you over the tough times.
Yeah, Vito will give it to you, with a few points on the dollar. Yeah.
So there is a carrying cost for this. I mean, if take me for example, I will probably look into getting a reverse mortgage, or when I'm the right age. I don't know if I'm going to use it. I think I personally, just knowing myself, I think I would use it to help mitigate the sequence risk of investing that we talked about.
Yes.
But assuming I do that, and assuming I pay my closing cost, because I don't like to owe anybody any money.
Yep.
I still have to pay that mortgage insurance every year, even though I'm not using any money.
That's correct. So there's an ongoing 50 bips, but you can maintain that. You can keep your balance down to around $100. This rarely is a problem, but it's worth mentioning. You never want to pay off the reverse completely, because that gets rid of the line of credit. So your loan officer should tell you that. But I have a number of people who have done that as well. And typically, they're either financially, more astute, or they've got a planner, and people will pay those off. They'll pay off the closing costs. And if you maintain it, it's not so difficult to make those payments if you're staying on top of it. Some people are never going to pay it, and that's something to take into account as well. So it just depends on the circumstances. Another one that we saw that's popular is people staying at home. They want to age in place. If you look at any study, and typically, when I left financial services, retirement to come into the reverse space, I traded Vanguard and Fidelity studies for AARP studies. So AARP would tell you it's in the 90% plus range of people that want to age in place. Nobody wants to go to assisted living.
I'm right there.
Even more so in the pandemic, because assisted living facilities, like any enclosed environment, and I hate to use the example, but like a cruise ship or a prison or something like that, they saw a lot of, the pandemic ran through those places because everybody was contained in one space. People want to age in place even more than before. They'll use the reverse to make the home more livable. So that's one of the features that you look at is, and as an advisor, even if you're going to look up the home on Google Earth or Zillow or a site like that, get an idea of what the home is built like. Here in Denver, if you have an 80-year-old who lives in a Victorian that's 3 stories tall with, narrow staircases and 10-inch risers, that's not built to age in place. We're looking for things, but you can stay in the same home, maybe change so the laundry's on one floor and everything's accessible. You can use a reverse mortgage to remodel the home. The 2 typical things we see, first is the bathroom, and the second is the kitchen. So making the home easier to age in place, you can use the funds for that. It's your money, so you do with it what you want. But typically, it's people using that. They may use the reverse to pay for in-home care, whether that's skilled or unskilled, nursing. And we know that it's not inexpensive. But when we're looking at, I look at the Genworth cost of care calculator quite a bit, and it drills down even to your zip code. Here's what cost of care is in your area for a semi-private room. This isn't even your own. You're talking probably $8,000 to $10,000 a month in Denver. That's an expensive proposition to look at. So if you can do this with a combination of, caregivers that come to your home, family, whatever, it creates an alternative. So you're not just looking at, hey, I'm going to go into this institutionalized type of lifestyle. So using it to pay for the home, bridging for long-term gap. I mean, it can be used for fun things too. And I'll put it one of my favorite stories because this was one of my clients. Married couple, the gentleman, he had 2 pensions. They were doing very well. They had, I want to say it was, north of $6,000 a month in retirement income. It fit their lifestyle. They wanted to take their extended family to Italy. They took the kids and grandkids for 2 weeks to Italy. It was an expensive trip, north of $50,000. When they came back, they brought me a bottle of olive oil, and I got to see all the pictures and that sort of thing. Because you work with them, it takes about 6 weeks to go through this, and we're asking them a lot of questions about their credit, what they intend to do. I mean, we're going to get to know them. They're with financial planners. They're your clients, but I'm a subset of working for Drew at this case. Just like you might employ an estate planning attorney or somebody that's an expert in this other area. So you can use it for things that you want to. We see people, hey, they want to, maybe they lost their spouse and then they're grieving because they went through this, but this was a great example as well. Hey, I wanted to redo my teeth. I think a new set of teeth is like, $25,000. If you took that money out of your IRA, you're going to pay, north of 30 because you're going to get, if it's taxable. But with the reverse, you can take it out and do that. And I feel better about myself. And I have, I still have, more to go. I have more to do in this life. So using those funds for yourself or for a loved one, sending grandchildren to help them send them to school or whatever it might be. It's not just dire circumstances, I guess I want to point out. It's your money. And that's really our message. What we fight more than anything else, Drew, is the perception of what this is. And it's changed dramatically. It is not the loan of last resort. The other thing that I'll point out to folks is they usually fall somewhere in the continuum of needs-based and wants-based. If I need the reverse, it's because I am just getting by on Social Security or I don't have enough money to have a secure, comfortable retirement. I need to tap into home equity. Wants-based is, hey, you know what? I want to convert some of my IRA money into Roth IRA because that gives me the ability to create a legacy for my family or heirs. And, that's not something everybody has the capacity to do. I find most people fall somewhere in that continuum, Drew, toward one end, in the middle, whatever that might be. But you can use the funds for what's needed. The other thing is keep in mind that, housing is a line item in your retirement regardless. So you're on a fixed income, you still have to pay property taxes, insurance, upkeep of the home. And depending on healthcare situation, it can be the most expensive part of your retirement. So National Center on Aging, which has nothing to do with any of the reverse mortgage companies, publishes a study called Using the Home to Stay at Home. And I'm not sure what it's like in the Carolinas, but on a lot of the East Coast, if you look at homes in like New Jersey, a $500,000 home can have property taxes north of $15,000 a year. Yeah. So you're on fixed income, $1,000 a month goes to property tax. That's expensive. Not to mention I still have to pay insurance. I have to upkeep the home, and upkeep is not fresh paint or an accent wall painted. It is, if you have a hailstorm, we need to replace the roof, right?
Right.
It can be expensive.
Let's say it looks like it makes sense. Then they talk to an independent counselor, right?
Yeah.
Okay. So
that's part of the process. Yeah.
Yeah. So I think people ought to be at ease that there's at least a non-biased third party who can help them judge, does this make sense or does it not make sense?
Yeah.
I think that's part of the problem. Before, a lot of people were being convinced that they should get a reverse mortgage by biased sources. And again, that was back probably early 2000s.
Early 2000s, there were bad actors that would say, let's get a reverse and then buy an annuity. Well, you're double dipping in there because the line of credit functions like an annuity. And if you take the 10-year payment, like the famous private investigator says on TV, you can get a monthly tax-free payment every month.
Yeah.
There are a lot of different ways to take money out, though. And you should talk to an expert about that, whether it's from my company or another one. We can tell you, here's the most advantageous. We can forecast it. So we have a forecasting tool called the Optimizer. RMF also integrates directly with Money Guide Pro. We can forecast with eMoney, Right Capital, Naviplan. So we can help that advisor show their clients and something they're used to seeing. Here's how it's going to impact your retirement.
Yeah. And I know that I would only need to collect a little bit of information. We don't need to, you don't even need to know the name of the party who's investigating this.
Yep.
To get some, initial information on what things might look like.
That's common. We need the age of the youngest borrower, the value of the home, any liens against it. It's helpful to have the zip code so we can estimate taxes, but not necessary.
I think the biggest hurdle that I see, the biggest pushback that I see is emotional, because people have this asset, it's tangible. They can open their statement at the end of each month. Oh, it's up, or oh, it's down. And okay, whatever. We shift the investments within it, and it's not going to impact their life. But they come home at the end of the day, and this is their house, and this is the house that they celebrated when, if they were lucky enough, they burned their mortgage.
Sure.
It's all over. I own it free and clear, and now they have to become comfortable with the idea that I own it, but there's someone else who can potentially have a claim on it.
It is. And when we look at this, I'm glad you brought this up, because it's not just an asset. It is the home. If you're anything remotely like me, I like older houses, and I'm the person who, hits his nail with a hammer and has to deal with that because I'm constantly doing something with the house. It's where we raised our family.
Yep.
Life events happen in the home. And the loan originator should take that into consideration. This is not selling a stock or a bond or a mutual fund. It's something that you've put blood, sweat, and tears in. It's attached to, near and dear, depending on how you think of the house, as part of you. So I like to think of it as you've climbed that mountain, you've built this up, you've made all those payments over years. Now we're in the decumulation stage, let the house pay for you too. So it's a mutual, it's a relationship that you've got with this inanimate object, but it holds something close to the heart more than ones and zeros on a page. So, yeah.
And the reality is that using a reverse mortgage could actually help you stay in that house longer than you normally would. And if you're thinking about handing it over to your heirs, they might love the home place, but it's not something that they're going to want. And they're not going to pick up and leave their house to move into your house when they have all the memories of raising kids in their home.
Very much so. Yeah, you need to know the story. It's not just, okay, we want to get X number of dollars out of this to do this. It is, what do you want this to do? Because that dictates what kind of strategy we're going to employ. So it's not black and white. These are what we're going to happen. Is we need to talk to the homeowners. What do you want to get out of this? What's your desired outcome? And that will help direct us to what sort of program works best for them.
If you're going to get a reverse mortgage, you're considering getting a reverse mortgage, have a conversation with your adult children. Include them in on the conversation. Find out, well, what are your thoughts? Is this something that you're expecting to inherit from me? And my guess is that a lot of the retirees are going to be surprised at the answers they're going to hear.
I would agree with you. Yeah. Drew, thanks for your time. And I really,
thanks again, Christian.
Yep.
Good info. Thank you much.
Take care. We'll see you then.